Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And it's time to get extremely honest in this video, everyone. As you know, if you've been following me for a while now, I'm a huge fan of covered call ETFs. They pretty much make up 100% of my portfolio. That's my goal anyway in the end, right? So obviously I'm a big fan, and there's a million YouTubers and negativity around covered call ETFs because they're very misunderstood and people really don't understand what they're designed for. So let's get extremely honest in this video, because we need to be honest, we need to tell the truth, right? So what I'm going to do is give you the big honest headline, and hopefully this is going to be a good reminder if you're thinking of buying covered call ETFs, if you own covered call ETFs, if you're worried because you're seeing all kinds of negativity about covered call ETFs. So let's be honest here. Let's get to it right away. All right, so let's not waste time, guys. Let's be honest here, and let me tell you the truth about covered call ETFs. Ready? Here it is. Keep in mind what I'm about to say is my opinion, and but it's a pretty well-educated opinion, I would think, and I think most of you would agree with me that covered call ETFs, I think that there is a 100% chance, not 99%, not 95, 100% chance that they will underperform their underlying assets or whatever you're writing covered calls on, whether it's an S&P 500 with covered calls, a NASDAQ with covered calls, a Tesla with covered calls. So the covered call version of that will underperform that or the underlying long term. So that is the honest truth, right? If you're buying the S&P 500 with covered calls, my opinion, there's a 100% chance long term it will not have as much total return than just an index fund or a passive index S&P 500 fund like a Vanguard or iShares. If you're holding a Tesla with covered calls on it, you would probably get higher, 100% chance you're going to get higher total return just owning the Tesla instead of the covered call version, right? So there is really, in my opinion, zero chance a covered call ETF will outperform its underlying for the long term. Short term, medium term, yes, it's possible. If the market is flat or in a downwards trend for, let's say, 6 months in a row, 3 months in a row, during that time period, the covered call one will probably outperform. That's what they do. They do better during a flat or down market. But really, there's no chance they're going to underperform the underlying. So all the criticisms I see about covered call ETFs, if you just add them all up, whether it's about the fees, whether it's about stock price and NAV erosion, whether it's about bang, you could all put it, in my opinion, in one bucket. Total return, they don't have as much total return as whatever they're writing covered calls on. And they're 100% right. And there's really two main reasons. It's not rocket science to understand why. Why is it that covered call ETFs will never, in the long term, right, in the long term, most probably just never outperform or do better than the underlying? Well, it's two reasons. One, fees. Covered call ETFs has much higher fees than just getting the underlying. If you just buy a Tesla stock, there's zero fees, right? If you just get a Vanguard S&P 500, we're talking tiny minuscule fees. Covered call ETFs will have much higher fees in the, it depends, it varies. It could be 0.45 to 0.85, right? So this is, if you're comparing to an ETF that has 0.1 or less than 0.1, it's like 5, 10, 15 times more in fees. That's because they're harder to manage. They're actively managed. The fund manager has to write those calls, whether monthly calls or weekly calls. They got to decide the strike prices. There's a lot more management and fees and time that goes into the covered call ETF. So that's number one. So right off the bat, higher fees, you're kind of at a handicap already versus the other thing, which has much lower fees. Important reason number two is that the market tends over the long term, the market tends to go more up than it goes down. So what is a covered call strategy, covered call ETF? You are, in one sentence, you're giving up upside, you're sacrificing upside for those option premiums, for that yield, for that income now. So again, you're giving up upside for yield, for cash flow, for income. So if you're giving up upside and the market goes up more than it stays flat or goes down over time or the long term, it's obvious that they're going to underperform just buying the equivalent underlying, right? So that's basically it, guys. That is the honest truth of covered call ETFs. I've never once on my channel said that this is a superior strategy. In fact, I was always honest about it, and I can't be more honest than this video here up front, making a video just on this. I know that by being a covered call ETF investor, over the long term, I will underperform just investing in the overall market passively via passive index funds. Okay, so one thing you guys got to remember, especially if you're invested in them, you're thinking of investing in them, or you're a critic and a hater of me and my channel and my style, covered call ETFs are not designed, for maximum total returns. They are designed for income generation and to lower your volatility or your risk. Volatility, risk, you could say kind of the same thing, right? Just like nobody buys bonds, government bonds, GICs, fixed income stuff do they buy that for maximum total return to beat the overall stock market? No, they buy it for more safety, consistency, whether it's for the income, but it's more for less risk, for less volatility, right? So I don't understand people will actually say or write in Blossom or whatever. I don't understand why people would ever invest in covered call ETFs. That's great. The power just went out. There we go. Sorry about that, guys. So people say, I don't understand why people buy covered call ETFs. Well, do you understand why people buy GICs and fixed income? Because there's a pretty big market for that, right? It's for less risk. Right? So that's just the main reason. Well, you need to understand what's important, guys, as a covered call investor. If you're thinking about it, you need to understand why you personally are investing in them. They're designed for income and to give you slightly less risk, less volatility than whatever the underlying thing is or whatever they're doing covered calls on, because that income helps you on the downside. Remember, risk, volatility, that has to do with the downside, right? It has to do with the downside. So when you're writing covered calls, you're generating premiums to cushion the downside, right? Because like I said before, if you're giving up some upside for income, during times where there is no upside, when there's a lot of volatility, when the market is flat, it's going down, there is no upside. So you're giving up upside, but you're not giving up anything during those times for that income. So the covered calls is really it's a defensive way to own the underlying whatever it is. So anyone who says covered call ETFs are risky, well, is the S&P 500 risky? Because a covered call S&P 500 is less risky than the S&P 500. So you got to understand, you got to cut through the noise and the nonsense and understand what these funds are designed for. And the important question is, why are you investing in them, right? If your number one priority is total return, I don't care about income right now. I just want to maximize my total return. I want to put 10,000, 100,000 and let it grow for 10 years. I don't understand why you would pretty much ever buy a covered call ETF unless you want a bit less risk during that 10 years. You'll definitely get less total return. You're going to get a little bit less risk or less volatility because, the market could be up one year and then hard down the next year. By doing covered calls, it's a bit smoother, that the returns are a bit smoother, a bit more consistent. So if your number one priority is total return, guys, you should not invest in a covered call ETF. It's just not designed for that. Okay, you don't put cucumbers and bananas on a pizza. It's not designed for that. And it doesn't mean you have to be mad at bananas or cucumbers either. I like bananas and cucumbers, I just don't put them on my pizza. It's just not designed that way. So stop judging and criticizing things if it's not according to your investing style, your personality, your time horizon. It's not, your objective is not income and less risk, then you don't need covered call ETFs. Okay, so yes, you could get them. You could buy a covered call ETF tactically if you're more of a trader and you say, well, I think for the next 6 months, a year, I have a strong suspicion that the stock market is going to be down or it's going to be flat. It's not going to do anything. So tactically, you could invest in a covered call NASDAQ or covered call S&P 500. But I think that's also a reason why you could invest in them tactically, as a trader. But if you're a long-term investor, total returns your number one priority, you probably should not invest in a covered call ETF. We just got to be completely honest. So reminder, everyone, a couple of reminders now to summarize. They're not designed to outperform the underlying. They're designed for income generation and to give you slightly less volatility, slightly less risk than the underlying, some smoother returns. Number two, they could, just like I just said, they can be used tactically for shorter, medium-term investors if you think the market's going to be flat or down. And number three, I think, in my opinion, I mean, these covered call ETFs, they're fantastic ETFs to reach fire quickly, right? If your number one goal in life is to be financially independent, to make enough cash flow so you could reach financial independence, they're great tools for that. They're really designed for maximum income generation, not maximum total return. And don't forget that, if I've seen heard all kinds of stories, and people write me letters, I retired 5 years early, 10 years early because of this strategy. Quality of life, you can't put a number on that, right? So yes, there's total return. You could quantify that with math, but you can't really put a number on, or a total return figure on retiring 5-10 years early. That is life-changing. That is a very, very big deal, where unfortunately you can't really put a total return number. So that's what I'll leave off with. We need to be honest with ourselves with covered call ETF investing. We are not investing them for maximum total return. It's not that we're completely ignore the total return, but there's a 100% chance we will have less total return over the long term than a passive index ETF investor. We just got to be honest. So if you like this video, hopefully it was informative for you. Give me a thumbs up. I would really appreciate it. And maybe another video, I'll go dig deep more into the risks of covered call ETFs, because I see a lot of nonsense about that. You want me to talk about that? Let me know. Leave me a like and a comment if that's something you really want me to dig deep into. What are the actual risks then of covered call ETFs? So thanks again for watching, guys, and see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.